Hey guys, it is Julie here with TipRanks. Today we're taking a look at 3 stocks with unanimous strong buy ratings. So let's get into it. Alright guys, welcome back. Thank you all so much for being here. Today we're taking a look at 3 companies that have attracted all buy ratings from Wall Street analysts. We're going to take a look at these companies, what it is that they do, and what those analysts are predicting for the stock's future. We came across these companies today using the TipRanks Stock Screener. Found right at the top here under Research Tools, we decided to look for a strong buy consensus from the best analysts and all analysts as well, double-digit upside potential, and at least a neutral or above rating on the TipRanks Smart Score. That gave us a list down below, and then we scrolled through looking for some solid blue circles here. Just before we dive into these 3 strong buy stocks, this is a friendly reminder that if you enjoyed today's video, make sure you hit that thumbs up button and that you're subscribed to the channel as well. And if you've been wanting to unlock some great investment research tools, check out the links in the description down below. Now let's get right into our stocks today. First up, we're taking a look at Allergo Microsystems. They trade under the ticker ALGM, currently priced at $31.82. Now, over the past year, they are in the red as they've cooled off a lot from highs back in 2023, down 31%. But in the last 6 months, they've climbed back 18%, and in the last 3 are up nearly 13%. Allergo Microsystems is a chip maker that specializes in integrated circuits, or ICs, particularly for various sensors and application-specific analog power systems. These chips have proven essential in the automotive industry, where they are a vital component of autonomous driving systems. Allegro's chips have also found applications in EV charging systems, industrial regulators, and various motors and motorized conveyor systems. The company has shipped out more than 11 billion sensors in its lifetime and has over 650 U.S. patents protecting their intellectual property. They claim that the average vehicle on the road today has 9 Allergo chips installed. They'll be sharing their first quarter earnings report in a couple of weeks on July 25th. This follows their 4th quarter and full year earnings that came out back on May 9th, where the company did have an earnings and revenue beat, even though revenue declined slightly, and the company reported record full year sales. For their Q4, they reported revenue of $240.58 million, which did decline about 10% year over year, but came in over $5 million better than anticipated, and earnings per share of 25 cents came in 4 cents ahead of estimates. Looking at the full year, their sales increased 8% to a record $1.05 billion. They saw a 38% growth in their e-mobility, which drove 17% year-over increase in their full-year automotive sales. Not only does the stock have unanimous buy ratings, some of those ratings are coming from 5-star analysts, including the analyst that is currently ranked number 1, Mark Lipikas from Evercore. He thinks that Allergo Microsystems is a strong buy on IoT growth, market leadership, and expanding margins, noting that the company is identified as a tectonic shift play in the emergent IoT market, which is projected to expand significantly with the potential to reach tens of billions of units. This positions Allergo Microsystems as a key supplier in a high-growth area. Lipikas anticipates that Allegro's operating margins will expand by 1,500 basis points over the next 5 years, reinforcing a favorable outlook for the stock. The stock's unanimous strong buy is based on 7 current analyst ratings, and the average price target comes in at $35.43, implying an upside potential of over 11% from current prices. Looking at our ratings down below, on the low end we do have a buy rating here from Barclays with a slight upside of about 0.5%, several around that 10% upside mark, and the high-end price target comes from Wells Fargo with an upside of nearly 26%. For our second strong buy stock, we're taking a look at Belden. They trade under the ticker BDC, currently priced at $91.55. This is another one that when we look at the past year did take a drop off and are down 5.5% in the past year, but have been climbing back recently, gaining 24% in the last 6 months and 4% in the last 3 months. Belden provides innovative signal transmission solutions. They design, manufacture, and market a comprehensive portfolio of networking, security, and connectivity technologies. They operate through 2 main segments, the first being their enterprise solutions, which offers network infrastructure, as well as cabling and connectivity solutions, commercial audio and video, and security applications. The other segment is their industrial solutions, which includes physical network and field bus infrastructure components and on-machine connectivity systems to end users. Their Q2 earnings report will be coming out at the end of July and does follow an earnings and revenue beat back at the start of May. Q1 revenue came in at $535 million. Now, this did decline 17% year over year, but beat expectations by about $20 million. On the earnings per share side, they reported $1.24, coming in 18 cents ahead of estimates. The company did say that stability is once again the key takeaway this quarter, with our teams delivering Q1 revenue and earnings per share that exceeded expectations. They were also pleased to announce that they entered into an agreement to acquire Precision Optical Technologies, which will be a new addition to their enterprise solutions segment. This is another stock that has some top analysts weighing in. The most recent rating comes from William Stein of Truist Financial, who is currently ranked number 6 out of over 8,900 Wall Street analysts. They said that the company's Precision Optical acquisition will enhance their ability to transition from selling products to solutions in its broadband end market. The firm is updating their model to reflect the financial impact of the transaction and also raise their 2025 earnings per share by 20 cents. Belden's unanimous strong buy rating comes from 4 current analyst ratings, and their average price target comes in at $112, implying an upside potential of 23%. Down below, we can see that recent rating from William with an upside of 34%, which is our high-end price target, and our low end is a 9% upside from benchmark. If you've made it to our third stock today, this is a reminder to make sure you hit that thumbs up button. Last but not least on our list is Braze. Trading under the ticker BRZE, they currently are priced at about $38 per share. This is another stock that is in the red this past year, down over 11%, and in the last 3 months, down nearly 12%. Braze is a cloud software company offering its users a customer engagement platform. They build their platform as a full-service database tool for marketers to enhance the customer engagement process. The company works with enterprise customers, large and small, including such names as Canva, Burger King, and Intuit. Marketers can use the platform to collect and gather data, take a wide range of actions on that data, and develop creative engagements with their customers in real time. Braze uses AI technology to power the platform, allowing for greater personalization, better customer outreach, and improved outcomes. Braze shared their Q1 earnings report back on June 6th. The company had a much narrower than expected loss and also saw some solid revenue growth. For their first quarter, they reported a loss per share of 5 cents, which was half of the anticipated 10 cents per share. Revenue came in at $135.5 million, and that was up over 33% year over year, driven primarily by new customers, upsells, and renewals. Just today, analyst Nick Altman from Scotiabank uprated their rating on the Braze stock. He said that Braze's underlying growth has remained extremely durable relative to the broader software group, but that shares have gone largely unrewarded, with virtually no multiple expansion and shares underperforming the IGV. The firm's most recent conversations give it heightened conviction in Braze's strategic positioning within marketing tech budgets and continued market share gains. And the Scotiabank analyst is not alone. There are 16 other Wall Street analysts that have all given the Braze stock a buy. And with that unanimous strong buy, the average price target is just shy of $62 per share, which would imply an upside potential of about 62% from current prices. Looking down below, we can see that increased price target from Scotiabank with an upside of about 47%, but that isn't even close to our highest. From Needham, we have a price target of $70, which would be an upside of over 83%. And going back a bit further, we have an $80 price target from Barclays with an upside of 110%. Our low-end price target isn't really that low, with an upside of 36% here from TD Cowen. So that is a quick look at 3 stocks, all with unanimous strong buy ratings from Wall Street. Let me know your thoughts on these stocks and which one catches your eye the most in the comments down below. I always love hearing from you guys. Please keep in mind these videos are never a suggestion to buy or sell any specific stock, so make sure you're still doing your own research and due diligence. Thank you guys so much for watching. I hope you have a great day, and I'll see you back here next time.